Hey guys, welcome to another one of our monthly updates. First bit of news probably was lower inflation coming in at 6.7. You've got to remember that in New Zealand inflation is quite backward looking. It's looking over the past year and inflation was high, go figure. The good news is it's coming down. It was lower than expected, and I think there's a lot more weakness coming through in those numbers than you would realise on first cut. When you think it had a very high food inflation number embedded in it, and that will work its way out. On the other side of it, we've got really weak construction, we've got increasing immigration, which means there'll be less wage pressure. We've certainly seen a lot out there in the last few months in terms of businesses starting to retrench. And so the labour market, I think, is starting to loosen up a little bit. All of these things are indicative of inflation getting under control. On the other side of it, we've got a whole lot of households that are experiencing much higher interest rates in terms of their mortgages, with still more to go, right? We've still got a lot of clients that are coming off these low rates, suddenly rolling into sort of 6% type interest rates, and the downstream impact on consumption can't be understated, right? It's going to have a massive impact in terms of how people are spending discretionary dollars. So I think it's fair to say that the market is very much viewing us as being at peak interest rates now. Will there be another OCR increase? My view is yes. I know others inside our business are saying no, they think it's done. I think the Reserve Bank will go the final 25 points because that's what they said they would do, and I think at this stage they'll very much want to deliver on their promise. So I'm expecting the OCR to get to 5.5%. It's going to have no impact on mortgage rates, and mortgage rates are now starting to price in potential falls in the next 6 to 12 months. We've got longer term mortgage rates getting down to around 5.99 now. You can get 3-year rates at that level all the way out to 5 years. I'd be a bit reluctant to fix that long, especially if you're doing it just to chase lower rates, because with rates expected to fall in the next sort of 6 to 12 months, there's going to be better deals out there. And the risk with fixing longer term is that as rates fall, you could expose yourself to break fees, which can be quite expensive. I'm not going to talk about break fees here today, but you can jump on the website. There's plenty of material on our blog about the risks around break fees and fixing longer term. So our advice at the moment would be only to fix for a year, maybe 2 years if you're a bit nervous about rates. And that's the mortgage market. In terms of house prices, look, we're starting to see a lot more activity in the market. It's coming off absolutely anemic levels. That can't be understated. I think, towards the back end of last year, house sales were at record lows for 30 or 40 years. But you've got to remember that our population has more than doubled in that time. And so, it just shows you how weak the housing market's been. Obviously, house prices have fallen close to 20%. Banks now seem to be suggesting that's as far as it's going to go. That's pretty much where we're in the market now, but the media will take 2 or 3 months to start reporting that. So we're basically there, 20% fall in house prices. Remember, when you overlay inflation on that, in real terms, house prices are down 30%. They're really back down to sort of pre-COVID levels, and that's why the Reserve Bank's come out sort of saying that they believe that house prices now are more sustainable as they start to reduce down interest rates. So what I'm expecting to see is housing turnover gradually pick up again. The reality is that the need for housing never goes away. People just sit on the fence when they're nervous. So people will gradually start coming back into the market. We're seeing more activity coming through from first home buyers. Obviously immigration's picking up a lot at the moment. That's going to add a little bit more fuel to the housing fire. We've really noticed it in the Auckland market where pretty much everything's rented out now. So for the last 2 or 3 years, the rental apartment market in the Auckland CBD has been very weak. No international students and not a lot of immigrants coming in and going from the country. That's completely changed again. So the word on the street is that property managers are basically full. And so in Australia at the moment, they've got a serious rental crisis going on. There's a real shortage of rental properties in Brisbane, Sydney and Melbourne. And you're going to see more of that in the news. It's going ballistic because of their very high levels of immigration. Look, I think markets like Auckland and other parts of the country are going to experience something similar in the next 12 to 18 months. The simple reality is as we turn immigration back on, our housing market's not going to cope with it. And here's the irony: this is all happening in a market where we're systematically destroying our construction sector again, which is what we seem to repeat every cycle. What we need to be doing right now is building more houses and keeping ahead of immigration levels, so that we can hold house prices, at good stable levels. Look, that's it for me for this month. A bit of a long-winded update, but lots to talk about. We'll catch you again later. Cheers.